I typically don't like them because I feel like it creates a bias. Because the average it doesn't feel like and the
Voting on everything.
yeah. I think yeah.
Okay, folks, time to get started. Couple of things. One is your second quiz is a week from today, and first 30 minutes of class. But then things are going to come at you very quickly. 2 weeks after that is the third quiz. This spring break was much later than it usually is, NYU, because there's only 5 weeks of class left. Usually there are 6. So the second quiz is next week. The third quiz is and 2 weeks after that is your final class. So project is due. So bang, bang, bang. And then, of course, you have your final exam. I don't know what possessed the people scheduling the exams to schedule them the way they did. Because you know what day you're scheduled for actually? The 14th, which is the absolute last day or potentially the last day. And many of you are graduating. So in a sense, it kind of pushes the grading up to the very end. So that's why I sent that email about, this, I don't like to give online exams for a lot of different reasons. But I think given the juggling of things that you'll have to do, I think that this year's final exam will be online. Unless you have very strong reasons why you prefer to do it physically as a regular exam, in which case, let me know. So I'm planning on an online exam in the previous week, so you can get it done, either the 8th or the 9th. So I'll work on the dates. I'm pretty flexible on that. But I don't think you want to take it on the 14th online because God only knows where you'd be checked out by then. No. So I will give you the final details. It'll be on Brightspace. It'll be online. The downside is it'll have to be multiple choice. It's very difficult to do a physical exam and grade it on Brightspace. So it'll be multiple choices. There's pluses and minuses. The right answer will be one of the choices. You can get that purely accidentally. The downside is there is no partial credit, which I really, I don't like that, but it is what it is. And usually when I give the same exam online and I give it physically, the average score turns out to be the same. So it's not like you score higher or lower in one. So if you have, as I said, if you have any serious objections, let me know. If you say, I want to take the exam on the 14th, I'll figure out a way so you can get it on the 14th at the scheduled time. But for the moment, I'm planning on giving the exam online in the week before. So, I do know how difficult it is to make airline reservations. So in a sense, I wanted to give you at least enough notice so you have like the 5 weeks to make those reservations when you can. So today we're going to, yes, go ahead, friends. Soon. By the end of this week. So if you have, in a sense, I've already decided on an online version for that first week. So if you want to do it at a different time because you can't be ready, just let me know and I will see what I can do. Yeah. So today we're going to complete our discussion of intrinsic value. And one of the things we're going to talk about is valuing banks. The struggle, and I know some of you are valuing financial service companies, you might have run into some of the same issues. But with a bank, which is conservatively capitalized, with banks, one of the things we're going to talk about is regulatory capital. To run a bank, you need to maintain your capital at a certain level. With capital defined in terms of tier 1, tier 2, tier 3 in banking language, but think of it as book equity. You need enough book equity to keep going in case there's a shock to your system. So if you don't meet those regulatory capital requirements, you break down. And there's a minimum requirement set by the regulators, but many banks choose to have more capital than required, a buffer. So let's say you have a bank that is conservatively capitalized. In other words, its regulatory capital ratios are much higher than they're required to be. That's good, right? But I want you to think through how this should show up in your valuation. Today we'll flesh it out. So when you look at the company's fundamentals, which of the following would you expect this company to have given that it's conservatively financed? A high return on equity, low risk, a low return on equity, low risk, a high return equity, high risk, or a low return equity, low. Let's break it down. First, in terms of risk, high risk or low risk? Low risk, right? But in terms of return in equity, what is the consequence of being conservatively capitalized? You have a low return equity, right? And of course, if you can break through and have a high return equity and have a high regular, then you're a magical bank. So when you look at banks, that's a screening process you can think of going through. We'll talk about converting it into a value. Many of you have started turning in your perfect DCFs, and please, please don't mess with the subject. My computer doesn't have a sense of humor. So when you say, not my perfect DCF, there's a reason I want that precisely in the subject. You know why, right? Because I've created a folder where everything goes into that folder. I can find it. So I've received about 25 or 30 so far, so people are moving along. So let's say you've finished your perfect DCF, you got a value for your stock. And for some of you, you already have that number. And that value is much higher than the stock price. It might not be right now, but by this Friday, it might be much higher than the stock price. You have an undervalued stock. Would you put all your money in that stock? Somebody want to play the game here? Somebody's already valued their company, found it undervalued, play it out. Anybody finish the valuation, found it undervalued? Okay.
Substantially undervalued.
Okay. So you found it substantially undervalued. Would you be willing to take all your money and put it in that stock? Well, he's got a baby due in August, so that's going to play a role in this, right? But you could already see whether you're willing to risk it all depends on, hey, what if happens if I lose it all? But tell me when you would take all your money and put it in one stock. Let's take that extreme scenario. Obviously, you're advised never to do it. What has to be true? When you're 100% sure of what? Well, first 100% sure about your value in the first place, and then 100% sure the price will converge to value, then of course you should put all your money in that stock. The further away you get from that, the more diversified you need to get. I mean, what I'm trying to get to is this heart of this debate about, is it better to hold a concentrated portfolio, or is it better to hold a more diversified portfolio? A lot of old-time value investors, you know what the advice is, right? Show conviction, own 5 or 6 stocks. What is this 25 stock? And I wrote a piece about this because you can't say categorically that one is right or one is wrong. I said it depends on how comfortable, how confident you are about your valuation, the price will converge to value. The more confident you get about both those aspects, the more you can concentrate your portfolios. The less confident you get, the more you need to spread your bets. I think we live in a world where there's far more uncertainty than 40 years ago. Macroeconomic terms, microeconomic terms. Maybe concentration made sense in the 1980s or the 1970s for a US investor investing in big US companies saying, where are they going to go? I don't think that same confidence can be used today. So even those old value investors might need to rethink that concentration advice based on the uncertainty we feel about the future. So let's go back to where I left you on the valuation packet, because I think we were starting on our discussion of emerging market companies. This Thursday, I'm going to be in Chile, and this Friday, I'm going to be in Argentina. First time back in Argentina in 20 years. And I can almost wager that the entire discussion is going to become macro very quickly. Because when you value a company in Argentina, behind every question you ask is a question about what is the country going to do? What's the currency going to do? So when I ask, what are your cash flows from existing assets? You can point to your financials, but underlying the financials is this country risk and currency risk. And ask you what the value of growth is. You can say it looks great right now, but that could change very quickly if the country goes to hell in a handbasket. How risky are you? So much of your risk comes from the country and the currency that there's not much you can do. In fact, one of the companies I'm going to value is Argentine. It's a regulated utility in Argentina. When I say regulated utility, what comes to mind? Safety, predictability. It's anything but safe and predictable. When you look at the financials, they're all over the place. reflecting the fact that the country's gone through turmoil. And I'll ask you, when will you be a mature company? Again, the country every question, the country becomes part of the story. So let's draw some very general lessons about valuing emerging market companies. And some of you might be valuing emerging market companies. Correct me as I'm going along if you think that I'm pushing in the wrong direction. First, country risk is an issue. It's a key issue. But you need a scalpel, not a bludgeon. So when you think about country risk, the way when I talk about bludgeons, taking every Argentine company and punishing it equally for being Argentine is going to give you a bad answer. The way we apply the scalpel is when you talk about equity risk premiums, we look at where a company is incorporated, but we also look at where it does business. So as you look at these valuations, that's why we use that weighted average equity risk premium or a lambda to kind of get a sense of not all Argentine companies are equally exposed to country risk. Second, currency is going to be an issue. I tried to value an Argentine company in pesos and I gave up like that. It's just a mess. It's a mess because inflation is, it's shifting. It's, it might be going down, it might not be going down. Finally, I gave up and I valued the company in US dollars. But the reality is, if you do it right, you should get the same answer. That's going to be my defense. When somebody says, why aren't you valuing San Miguel, which is, Argentine lemon firm in Argentine pesos? My answer is, if I do it right, I should get the same value for the company in dollars as in pesos. Why? Because inflation is the only element that comes into evaluation of the currency, and picking a currency where I feel more comfortable about those inflation expectations allows me to stay with the story and value the company better. I know I've said this before, but you probably don't believe it. So I actually took a company. This was Infosys, an Indian company. This was about 7, 8 years ago. I'd valued first in Indian rupees. Okay? And I got a value of 614 rupees per share. Then I revalued the same company on the same day in US dollars. And I'll give you the good news first and the bad news later and what happens when I switch from rupees to dollars. When I switched from rupees to dollars, my cost of capital went down. Why? Is it? Yeah.
Because its rate is different
Because of inflation, right? It's not because country risk went away. This is one thing that that when people talk about dollarizing cash flows, remember, dollarizing cash flows doesn't remove the country risk. It just takes the inflation effect out. Lower cost of capital because I have less inflation in dollars. Then I did my growth rate, and here's the bad news. My growth rate, which was 12% in rupee terms, became 8.78%. Why? For the same reason. The same inflation that is pushing down my cost of capital is also pushing down my growth rate. But the bottom line is, when I compute the value per share that I get is exactly the same if I do things right. That's going to be my defense next week when I present that Argentine company in US dollars is, look, I know that I'm being chicken here, not dealing with pesos friendly, but I'm going to value the company in dollars. And as long as I stay internally consistent, it actually makes me focus more on the company and less on the currency and as I do my analysis. Yes.
Your Argentina, you would still do the same.
Absolutely, right? It's just, I mean, you're in New York. Can you state the temperature in Celsius instead of Fahrenheit if you wanted to? Yeah, right. And so the fact that, and it doesn't change the weather any, right? So it's basically this, I come back to the Celsius Fahrenheit because it's so clearly an analog to using different currencies in this process. Third, and this is not just exclusive to emerging market companies, there is this corporate governance issue, which is when you look at emerging market companies, many are part of family groups. It's very difficult to remove management if you don't like the way they behave. I know corporate governance became a hot topic starting the start of the century, 2000, 2001. Corporate governance took off as a topic in the US after the Enron fiasco, and people said corporate governance matters. You had a law that was passed, Sarbanes-Oxley, supposedly designed to improve corporate governance. And it did some good things, right? It said your board of directors can't be composed of your cousins, your nephews, your uncles. There's got to be some degree of independence. But it became too focused on what I call checkbook corporate governance. What's checkbook corporate governance? You have a big board of directors, you have an independent. So basically, check, 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 and you checked it all, you got a high corporate governance score. In many ways, I think we missed the boat on corporate governance. Corporate governance is not about checks and check boxes. It's about being able to change the way a company is run if you don't like the way it's run right now. So I'm going to give you an example of how corporate governance plays out in valuation. And we talked about this discounting the effect last session at the start of the class test, which is, would you discount? And I said, no, because it should already be in your numbers. And if you're wondering how that happens, here's an example. This is a South Indian company called Tube Investments. It's been around a long time. It's a family group company. It's an old economy company. And it's a company that reinvests a lot. Looks like it has a pretty healthy growth rate. In fact, it has a reinvestment rate of 60% and a return on capital of 9.2%. So basically, it looks like a decent company if you look at the numbers without recognizing the numbers were in rupees at a time when the rupee risk-free rate was 12%. It's a company that's growing, but growing by taking investments that are well below the cost of capital. Now, if this were a company with strong corporate governance, what should happen? Somebody should step in and say, guys, you can't keep doing this, earning 9.2% on your project when your cost of capital is 16.9%. And if this were a company with strong corporate governance, you'd start with this and over time very quickly move to a point where you at least earn the cost of capital. That's what activist investing does. That's what. But this is a company with there's zero chance of outsiders coming in and changing the way the company is run. So in valuing the company, here's what I did. I left the return on capital at 9.2% for the near term. And even in the long term, and I got to stable growth, I left the return on capital below the cost of capital. This is a company that is going to earn less than its cost of capital, not just for the next 5 years, but in perpetuity. That's weak corporate governance. The value per share that I got was about 62 rupees. The family that ran the company was a little disappointed that I got, because they thought I would come up with a value higher than the price. And they said, what can we do to make the value higher? Because there's a very quick fix, right? What do they need to do? Stop investing, right? If you made the reinvestment rate 0 and your growth rate 0, your stock price would, or your value would jump to about 100 rupees per share. Second, you need to kind of separate yourself from the company where effectively you bring outsiders in to run the company, because run as is, the company is being driven down in value every time you try to grow. So I'm not asking for miracles. Don't take positive net present value projects. Maybe they're not there, but at least stop taking negative net present value projects. Bring the growth down to 0. That would remove the drag that is created by all that growth where you earn less than your cost of capital. So here's how it will play out in your valuation. Many of your companies, especially if they're older, more mature companies, you might have a return on capital less than the cost of capital. What's the default in the spreadsheet? Stable growth. I push it towards the cost. I push it to the cost of capital. I'm assuming that in the long term, it'll be crazy for you to keep earning less than the cost of capital. If you have a company with bad corporate governance, change that option. Set the return on capital below the cost of capital, because in effect, you will not be able to stop the company. The worst part is they didn't think they had a problem. They said, we're making money. And that's the problem when you earn less than the cost of capital. You're not a money-losing company. It's not obvious you're doing a bad thing. You're just not earning enough to cover the risk you've taken with that capital you've invested in the company. Any questions on corporate governance? So if you're valuing Meta or Google, do you have the same issue? You have the same issue in terms of loss of corporate governance. The only thing that keeps them not having this discount is right now they earn well above the cost of capital. And you're saying, please God, let that continue to be true. That way I don't have to worry about replacing Mark Zuckerberg or, and I think that's the worry you have with these big tech companies is we've created enough incumbency power in the way we've constructed the voting and non-voting shares that even if you don't like the way they run, you're kind of stuck with them as is. So it makes me a little wary because I'm invested in both those companies. Makes me a little wary. What happens if tomorrow Zuckerberg wakes up and goes on a spending spree? like he did with Metaverse, right? There he pulled back from the edge. How are you going to stop somebody who's got that voting power to be able to do whatever they want? Cross holdings. Again, not just restricted. It used to be that US companies had very few cross holdings. That's starting to change. I mean, Microsoft, when you value Microsoft, there's that open AI holding out there. So increasingly, this is starting to show up even in markets where you thought cross holdings were not an issue. In many emerging markets, though, where you have family group companies, cross holdings are often a feature of these companies because of their history. What I mean by their history is these cross holdings were not accumulated by chance. They were accumulated because 30, 40, 50 years ago, when they were private businesses, it was just a transfer of capital across the companies. Just to give you a sense of how much cross holdings can affect the value of family group companies, the value from 2010 of 4 Tata companies. They're all part of the same family group. Tata Chemicals, Tata Steel, Tata Motors, look at how much of the value comes from cross holdings. So basically, the red part is cross holdings, and you can see 47, 47, 37%. And then you have Tata Consulting Services, where the cross holdings are only 5%. Why is TCS so much less exposed to the cross-holding problem than Tata Motors, Tata Steel, and Tata Chemicals? Yes, Michael.
Maybe the high capital expenditure rate of the other companies, they might own their upstream and downstream of them.
It could be that, but I don't think it has much to do with reinvestment characteristics. It's something much more, I think, much simpler. How did I say these other companies acquired the cross-holdings? Through their history, right? TCS is the youngest of these 4 companies. It's a consulting, it's basically, it's an outsourcing company, a software company started in the 1980s. It hasn't had a chance to accumulate all this other stuff that so even within family groups, when you look across family group companies, I'll wager that the youngest companies in the family group have the least of a cross-holding problem. The older the company gets, the more you have this legacy effect of investments from 30, 40, 50, 60 years ago. And finally, again, not specific just to emerging market companies, we worry more, is truncation risk comes in lots of different forms. What is truncation risk? Normally, when you think about risk, you think about being wrong on your year 3 or year 4 cash flows. Truncation risk is there might be no year 3 or year 4. And here are some of the ways. One we've already talked about in the context of distress, right? Default risk, but these are more general. One is it can be a natural disaster, where a company is essentially affected by that natural disaster and put out of business. It could be terrorism risk in some parts of the world. And in some parts of the world, it can be nationalization risk. So if you're valuing a Venezuelan company, you're looking over your shoulder saying, what if the government takes over my business? Saying, how do I bring it into my discounted cash flow valuation? Here's what you cannot do. You can't try to adjust the discount rate for any of these risks. You have to figure out a different way of bringing the risk in. So I'm going to take an example. Valuation I did of Aramco. Most uncommon IPO when it happened, like 2019. Everybody's familiar with Aramco, the company, right? What does it do? Basically, it's the simplest story in the world. 300 million barrels of oil under the Saudi sands. You stick your finger in, the oil comes out, the lowest cost reserves in the world, right? So value the company, and you can value based on dividends. It's a cash machine. It generates $100 billion in free cash flow equity every year. I came up with a value of about 1.6 billion. So whether the dividend discount model or free cash flow equity model, 1.6 to 1.7 trillion dollars. Overnight, it became the most valuable company in the world the day it went public, because at that time, Apple's value was actually less than. I finished the valuation and I said, well, I'm ready. But then I step back and say, is Aramco really a company? 80% of the Saudi budget comes from Aramco cash flows. You're really buying a country, not a company. And then you step back and say, am I really buying a country or a piece of the royal family? Because they're all connected, right? The Saudi family, the Saudi Arabia, and Aramco. And you're making a joint bet on all 3. And in this valuation, what are you assuming? All 3 will stay intact. 3 years ago, if I asked you about Assad and Syria, you'd have said dictator for life. Zero chance of that ever changing, right? Look at how quickly that shifted. Is there a chance that the Saudi royal family could be displaced sometime in the future? Clearly, the probability is not zero, right? That they will not. So there is a chance. And if that happens, will your value of equity in Aramco be affected? Absolutely. Hopefully, it's not ISIS taking over Saudi Arabia, because then your Aramco value might go to zero. But it might be a less friendly regime. You know how that plays out? If you have a less friendly regime, they'll charge you more royalties per barrel of oil. It's as simple as that. They don't have to nationalize you. You'd say, pay us $40 a barrel instead of $15 a barrel. Overnight, your margins drop, your cash flows decrease. So here's what I did. I estimated a probability of a regime change. Remember, it's a 50-year cash flow. So 20% might look high, but it's a 20% chance of a change over the next 50 years. And if that happens, I assume that your value will have. I'm just making up numbers as I'm going along. I'll be quite honest, because I don't really have the capacity to assess but if you're investing in Aramco, you're implicitly making an assumption about regime change. Might as well face up to it and say, in this company, my biggest challenge is not the price of oil or the reserves. It's really dealing with the political risk underlying this company. Now, in the case of Aramco, though, you know what percentage was offered to the public at their initial offering? It's 3%. 97% is still held by the Saudi government. And it was restricted in terms of who can invest in it. I think you have to be a Saudi citizen, maybe. I don't even know the details. So it's really a for show offering. But to the extent that this were 51 or 60%, I'd wager this question would be much more front and center. So anytime you have discrete risk, better to deal with it it's basically a decision tree from statistics, right? Going concern with the Saudi royal family, going concern with a different regime in place, value twice, take the expected value. Now, I did a valuation of EasyJet, the UK-based discount airline, just before 2018 or 2019. And for those of you who remember, in 2018 and 19, Brexit was still in this strange space. I mean, people weren't sure whether there's going to be a hard Brexit, a soft Brexit, or no Brexit. There's huge consequences for EasyJet. Because, bulk of EasyJet's revenues come from flying British tourists to Greece and Portugal, to those warm beaches. And if it had been a hard Brexit, there was a very real chance that EasyJet would have been banned from flying, because you had to be an EU-approved airline to fly to those airports. So they actually had a backup plan where if there was hard Brexit, they'd move their entire headquarters to the Eurozone. It cost them billions of dollars and lowered their value. So I actually value the company thrice: hard Brexit, soft Brexit, no Brexit, attached probabilities to each of them, and took an expected value. So any of your valuing companies where there is that discrete risk, better to do two valuations rather than try to put them all into one number. Which brings me to valuing banks. Now, I made a confession up front that I used to think valuing banks was easy. And as I describe the process of valuing banks, you see this play out. Let's suppose I came to you with the bank and you said, look, I'm going to value the bank. Let's go through the 4 questions. What are your cash flows from existing assets? Well, how do we compute cash flows? We start with earnings, we subtract reinvestment, CapEx, depreciation, working capital, and we come up with cash flows. Imagine trying to do that for a bank. You can start with the earnings, but if you think about CapEx, depreciation, change in working capital, you're going to very quickly be grasping at air. So most people, when they try to estimate cash flows of a bank, give up. Second, when I ask you what's the value of future growth, again, if you can't decide what's in your capital, how do you decide whether you're earning more or less than what you need to? So assessing the value of growth becomes difficult. On risk, remember how we got the cost of capital for a company? We got the unlevered beta for the business they were in and re-levered back up using a debt to equity ratio for the company, and then brought in debt ratios and cost of capital. You try that very quickly, the process goes to mush in a bank. Because what's the debt to equity ratio for a bank? What's debt to a bank? Is your deposit in a bank debt? And finally, when will your company be a mature company? With banks, you really don't get pushed out of existence. You get taken over by somebody and run differently because you have deposits at play. So the whole game becomes very different with banks. So let's focus in on some of the issues you run into with banks by looking at how I used to value banks before 2008. There's a 2015 valuation using the same approach. Before 2008, I tried to look at a bank and say, you know what? I can't estimate cash flows. So I'm going to be lazy and assume that what a company pays out in dividends are its cash flows to equity. Do you see why this requires a trust in management? You're essentially assuming that what banks pay out in dividends is what they can afford to pay out. And then you would discount back at a cost of equity using the average beta for a bank, no levering and unlevering, implicitly assuming that there are no risky banks and safe banks, and the regulatory authorities will make sure banks are pretty much at average risk. It made life easy, but it was built on those assumptions. Regulatory framework works, manages that banks pay out what they can afford to. So in a dividend discount model, life gets very simple, right? You project out the net income. Here, for instance, this is an Egyptian bank. You project out the net income. You project out a payout ratio, which will change as your growth rate changes, because as your growth decreases, your payout ratio will go up. You can use a dividend discount model to value a non-dividend paying bank. Because as the growth decreases, the payout ratio will show up, the dividends will start to get paid out. You discount them back at the cost of equity. In this case, I discount them back at a risk-free rate plus beta times risk premium in Egyptian pounds. The value per share that I get is about 42 pounds per share. Dividends discount back at the cost of equity, but it's built on that presumption again of managers paying out what they can afford to and regulatory framework working. So let's look at what's changed over the last 15 years that makes it more and more dangerous to use a dividend discount model. First, financial service firms are opaque. What do I mean by that? You read the annual report of a bank, there's so much they hold back. There's a Faustian bargain we've made where with banks, we allow them not to tell us very much about what happens, and we trust that the regulators are getting that information that prevent a bank from doing really stupid things. So with the bank, you could read an annual report backwards and forwards and still not understand what exactly is going on. To estimate cash flows for a bank, obviously below earnings, you're kind of looking for capex and depreciation, can't find it. And during a crisis especially, you can't trust banks to pay out what they can afford to because they're locked into dividend policies. So for financial service firms, the book value matters. Every company so far, I've never tracked the book value of equity. Right? Basically, I do the cash flows, I come up with the present value. With banks, book value matters because book value becomes the basis for regulatory capital. So tier one capital, a big chunk of it is book value of equity, and most of it is supposed to be equity-like. So the way regulators define equity-like kind of makes you uncomfortable. It's supposed to be equity-like. So to grow as a bank, you need to invest more in regulatory capital. It becomes like CapEx. If you're an undercapitalized bank, to survive as a bank, you've got to come up with that extra regulatory capital. So in 2009, as I was thinking about how do I get out of this dividend box, here's a concoction I came up with, and you can tell me whether you can go along with it or not. I'll start with net income. First, remember with the bank, don't even try to value the entire firm. Focus on equity because debt to a bank is raw material. Focus on equity, start with net income. And for my reinvestment, I'm going to define reinvestment as what the bank needs to come up with as regulatory capital to keep going. So you're a growing bank, you'll need more reinvestment than if you're a stable bank. If you're an undercapitalized bank, you will need more reinvestment than if you're an overcapitalized bank. This becomes the way I can reward you as a bank for how you're capitalized. The right page now. You have the Deutsche Bank on yours too? Or do you have? Okay, let me make sure. Okay. So this is a Deutsche Bank evaluation. I did a Deutsche Bank in October of 2016. The blog, I will send you the link to the blog post. The title of the blog post was A Greek Tragedy at a German Bank. And I chose those words deliberately because you know how the Germans think about the Greeks, right? They can't run anything. And this was the quintessential German bank facing what the Germans would have called Greek problems. I mean, Deutsche Bank, starting in 2008, after the crisis, had a series of crisis after crisis after crisis. And each crisis was another $1 billion, another $1.5 billion. And every time you have a loss, guess what happens? Your book equity gets reduced, your regulatory capital takes a hit. This was in 2016. And right after the Department of Justice had fined Deutsche Bank $10 billion for something they did in 2008 during the crisis. So you have a fine that comes out of your book equity as well. And it put Deutsche Bank in a very precarious place. Their regulatory capital ratio dropped to 12.41%, their tier one capital ratio. You say, how do I know that's high or low? If you go to Capital IQ, you can actually download the tier one capital for every bank. And if you look at where 12.41 falls, it falls to the first quartile. They dropped below the median to the first quartile. They needed a lot more regulatory capital. In fact, they targeted that they needed to be at about the 75th percentile because they had riskier businesses than a typical bank. You're a significantly undercapitalized bank. You're at 12.41%. You need to get to 15.67%. They're a slow growth bank. There's not much growth that's going to bail them out. So I took the tier one assets, which are, it's called risk-adjusted assets. This is a whole set of language that comes with banks that you can get familiar with if you're working with a bank. Risk-adjusted assets, basically their assets adjust for how much risk they take. The more risk you take, the larger that value becomes. And that's what your tier one capital requirements are based on. So they're a slow growth bank that's significantly undercapitalized. And I fixed them on a spreadsheet, just like I did Las Vegas Sands in the last session. To fix them, what did I need to do? First, I brought their tier one capital ratio up, which requires them to reinvest increasing amounts over time, especially in the early years. So basically, we look at the regulatory capital investments, huge reinvestment needed up front, because without that reinvestment, they were in danger of not being nationalized, taken over by the government, like the Royal Bank of Scotland was after 2008. I did improve their return equity over time, but I'm not expecting miracles. In my best case scenario, I expect them to earn a return equity roughly equal to their cost of equity. So over time, I'm expecting the return equity to improve to the cost of equity, the regulatory capital ratio to be fixed. But take a look at my free cash flows equity. My net income goes from a loss to a profit as my ROE improves. My investment in regulatory capital acts like reinvestment. My free cash flow equity is minus 11.7 billion in year one, minus 3.7 billion in year two. You can see for the first 4 years, I'm negative free cash flow equity. If I'd used a dividend discount model to value Deutsche, the lowest number I can give them is 0.0000, but that's not catching the negative cash flows that are coming up. You take the present value of those cash flows back, you get a value of equity today. Based on my assessment, at least the stock company, Deutsche Bank, did look undervalued. But that's assuming they can make it back to health and earn their cost of equity. There was a very real chance in October of 2016 that they would not make it. Would not make it in the sense that the German government would have to step in and take them into receivership. I attached a probability of only 10%. Why? Because they're in a sense too big to let that happen. So my guess is other financial institutions will bend over backwards to keep them going. So that's why I put a fair, and that's what's so unfair. If this had been a small bank with these statistics, there's a 50% chance of this happening. Here, there's a 10% chance. If that happens, my equity is worth nothing, the 10%. The expected value that I got was about 21 euros per share. So this is a trouble bank, and the way you're reflecting its trouble, it's negative return equity, it's undercapitalized, you fix it, you essentially get negative free cash flows equity. In fact, the year after I did this, Deutsche made a rights offering for about $11 billion. You know how rights offering works? They offer the existing shareholders shares in the company at a discount price. And they raised 11 billion to cover that. So you saw that negative free cash flow equity play out. The dilution is already built in. So if you have a trouble bank, you have bigger hole to fill. But if you have a bank like Citi or JP Morgan, it's a much easier fix to make because you're already pretty close to regulatory capital ratio. And there, your value is almost entirely going to be driven by what kind of return in equity do you make. relative to your cost of equity. So how many of you value financial service companies? Because with banks, the regulatory capital works. With insurance companies, you're going to have a tough time getting an equivalent. So you'll have to come up with your own proxy for what reinvestment looks like. But it takes a little more of a, it's a little more of a challenge coming up with what you call that reinvestment number. One final point, we talk about financial service companies, banks, insurance companies, payment processing companies. The way you build up to the cash flows has to reflect how they make money. You know what I mean by payment processing companies, right? MasterCard, Visa, the old time, PayPal. So to estimate the cash flows, the income they will make, you have to start with how they make money. If you have a MasterCard, how does MasterCard make money? Yeah.
The traditional business, but now they're selling their data. It makes like 50% of their revenue.
Let's put the data to the side. Let's look at the payment processing side, right? You use a MasterCard at a restaurant, transaction happens, they get, I think 2.5% to 3% of whatever the transaction is. American Express, it's 4%, PayPal, it's 2.3%. It's called the take rate. So basically, it's every transaction that happens in the platform, they take a percentage of that, and that becomes that's the base revenue. And then it's an intermediation service. Whatever costs come out of that, the margins are going to be high. MasterCard is a money machine because, people talked about how disruption would ruin the MasterCard business. They've actually prospered in an age of digital alternatives. But it's based on gross transactions and take rates. So about 4 years ago, this Indian payment processing company called Paytm went public. And it's one of the worst, it's a valuation that I would go back and say, I wish I'd done things differently. I'll tell you what its biggest selling point was. At the time that they went public, Paytm had 330 million people on its platform. That's dazzling, right? And was going public. And I made the mistake of assuming that the people running the company actually wanted to build a business. What does that mean? That now that you have 330 million people, you want to try to increase the take rate. The take rate at the time Paytm went public was about 0.83%. I'm sorry. Yeah, 0.83% or 0.8%. Just to give you a contrast, we talked about the 2.5% to 3% that MasterCard and Visa make, and the 4% American, this is 0.8%. Alipay was making 2%. So it's a really low take rate. But I was willing to concede that they were doing that to build up the number of people on their platform. And I assume that now that you have 330 million people, you turn your attention to the take rate and try to improve the take rate. I completely screwed up. Because after they went public, what the management seemed to think was that their objective should be increase the number of people on the platform, not improve the take rate. So if they improve the take rate, the value per share that I attached, you can see at the bottom, it's kind of covered up, was about 2,000 rupees plus per share, which was roughly around the offering price. Today the stock is trading at a few hundred rupees per share because the take rate has stayed stuck. So one of the mistakes I made was assuming management focus on the take rate. The other mistake I made, and this is something I should have considered, is in India, there is actually a free payment processing service called UPI. The government offers it. So effectively, you're competing. And while it's not for every merchant, you can't use it. It's a free service for at least payment processing, which effectively means you're competing against a payment processing service with a take rate of 0%. That's going to keep payment take rates in the US or in India for payment processing companies at well below what they are in the rest of the world. Okay. So if you take a look at Paytm, if any of you are valuing Paytm as part of this class, one of the things to factor in is a lower take rate, even if management comes to its senses. But this is what happens when you get focused on number of people on the platform and don't pay particular attention to how much money you're making off. Final example, and I think this is the last of the intrinsic. We've talked about valuing companies with intangibles and intangible assets, things you can't see. And in accounting, this has become almost a fixation, bringing intangible assets onto the balance sheet. Let's look at what makes intangibles difficult. And it's really nothing to do with valuation specifics. It's got everything to do with accounting screwing up. So when I ask you, what are your cash flows from existing assets? When you look at companies with significant percentage of their assets being intangible, the earnings are not truly the earnings. And what you see on the balance sheet doesn't truly reflect what you've invested. I don't want to be mysterious, but if you're a pharmaceutical company, your CapEx, your biggest CapEx, which is R&D, is expense, which makes your earnings not really the earnings. And because they're expense, those assets don't show up in the balance sheet. They're not part of your invested capital. When I ask you, what's your value from future growth? Again, because I'm not capitalizing what you invest, I really don't know what your return on capital is. I don't know whether you're beating your cost of capital. The risk part, I think you can answer because it's about based on market values. And finally, when you talk about when will my company be a mature company, intangible assets have very different lifetimes than traditional tangible assets. The brand name can last potentially forever. So the challenges are often not in terms of valuation, but in terms of getting around the accounting for these companies. Okay. So the accounting rules are filled with inconsistencies when it comes to intangibles. And part of the reason we spend so much time on capitalizing R&D is to try to make companies with intangible assets look very much like companies with tangible assets. So when you capitalize R&D, what happens? Your earnings get restated, your capital gets restated, the return on capital gets restated. But now at least you have a more realistic sense of what the company is worth. So technology companies, pharmaceutical companies, consulting companies, if you don't do this, you really don't have a basis for a solid valuation. Okay? So when you look at an Amgen, there's the accounting numbers for Amgen. This was the R&D adjustment because Amgen was one of the companies we talked about in the context of an R&D adjustment. There's with no R&D adjustment, that's the accounting numbers. Those are the numbers when I capitalize R&D. My operating income increases from 5.07 billion to 7.3 billion. My invested capital jumps by 8 billion. My return on capital becomes actually a higher number, 14.58 to 18.26, which is unusual when you capitalize R&D. But the value per share, which is ultimately what we care about, went from $43 per share to $74 per share. Capitalizing R&D made Amgen a more valuable company, at least in my eyes. But this is not a generalization. This is not going to happen for every company. If I took Merck and did exactly the same, went through the exact process, the value per share decreases when I capitalize R&D. And there's a simple reason for that. When you capitalize R&D, you're bringing it to the same level as all other CapEx. And when I ask you, does CapEx create value? What's the answer? It depends, right? It depends on what? What kind of return on capital you make versus your cost of capital. Amgen, the value goes up when I capitalize R&D because its R&D has generated a return on capital higher than its cost of capital. For Merck, the reverse has been true. So when you capitalize those intangibles, that's all you're doing. You're bringing it to the same level as any other investment. So I'm going to finish the intangibles discussion with the most uncommon company. 2 years ago, this company called Birkenstock went public. Any of you own Birkenstocks? Yeah. Ugly looking stuff, but very, very comfortable, presumably, right? I mean, they're very odd looking, right? Not maybe ugly is the wrong word. Odd looking sandals. They're supposedly very comfortable. Do you know the history of Birkenstock? Dagmar, do you know? France?
Yeah, the German, very old shoemaker.
250 years old, right? Created by Germany. And for the first 200 years of its existence, it was Germany focused, and they sold their sandals only to these clinics which dealt with people with foot problems. That was the early market. And then in the 1960s, a German American went back to Germany during the summer, and she had foot problems, tried out Birkenstock, really found them comfortable. She went to the owner of the company and she said, would you be okay if I took these sandals back to the US because I think people would find them, they might like them. He was very resistant, very German. He said, no, this is German. We do only foot clinics. We don't do this US stuff. But she must have been very convincing because she managed to convince him to give her, a few hundred pairs of shoes. I know how she flew with that many shoes on a flight, but I guess the weight requirements were not as rigorous. She flew them to store in LA, and the rest, as they say, is cultural history. Because somewhere in the late 60s, a hippie wandered into that store. And what's the essence of hippiedom? That you did not want to be like traditional people. Traditional people in the 1960s wore suits and shoes. And as a hippie, you didn't want to do either. So it took off in the 1970s. In fact, there are pictures from Woodstock in the 1970s. If you've seen pictures of Woodstock, it's raining, it's upstate New York, and your people in Birkenstock must have been incredibly uncomfortable, but it became part of that rebel. That was the starting of the brand name building up for Birkenstock. If you don't want to be like everybody else, you wear Birkenstock. So Birkenstock sold on that basis. Then it leveled off. In 1992, a 16-year-old model called Kate Moss became one of them, was on the cover of Vogue wearing Birkenstock. And again, it took off on campuses. Sure. And then it became the choice for celebrities around the world. And they did it without, I mean, Birkenstock has never paid a celebrity to wear their shoes. The best kind of advertising you can get. But Steve Jobs wore Birkenstock. His Birkenstock actually went on sale a couple of years ago. Somebody paid $250,000 for it. I hope they're not wearing it around. You know, you pay $250,000, you put it up on the wall, and you say, those are Steve Jobs Birkenstock. But the point I'm making is when we think of brand name, we think of lots of advertising. We forget the fact that a lot of brand name value comes from being in the right place at the right time and accidents in history. So in 2023, Birkenstock went public. At the time they went public, there were 4 intangibles that I could think of. But basically, if you look at intangibles, this is the point I made. It has to show up somewhere in the numbers, right? The cash flows, the growth rate, the discount rate. You name the intangible. I'm looking for a place to put it. In most cases, finding a specific intangible is tough to do. A specific place to put it is tough to do. In the case of Birkenstock, so here are the 4 intangibles. First, there is the brand name. It's one of the most recognized names in shoe wear in the world. We could talk about how it got there. Second, the celebrity customer base. The people who wear Birkenstock and they're visible. Oscars, I've seen people collect their Oscars wearing Birkenstock. Third, Birkenstock until 2011 was family run as a company. In 2011, they hired this guy, Oliver Reichert, who's turned out to be an incredibly good CEO for the company because it was a company that was leveling off in terms of growth, 7 or 8% when he came in. He managed to make that growth 15, 20% by partnering with big brand name companies. There's a version of Birkenstock. It's a Prada Birkenstock. It's cost $1,200, where he partnered with Prada saying, look, you know, we take the Birkenstock, we'll put a Prada imprint, whatever that is on it. Do you have Prada Birkenstock, Dagmar? Okay. No. $1,200 sounds like a little bit of a stretch. But basically, he did things that preserved the brand name and found growth. And finally, in the summer leading up to the IPO, and this was completely unplanned on the part of Birkenstock, the Barbie movie came out. You see, what's a Barbie movie got to do with Birkenstock? Remember the Barbie movie? She wears pink Birkenstock in it. And sales of Birkenstock took off that summer, increased by 30%. But what is more interesting is the kind of people who came in and bought Birkenstock. Okay. I don't want to insult Dagmar, but I think that the median Birkenstock buyer tends to be female and older, right? So it's, and this brought in a new, did you start buying the Birkenstock after the Barbie movie? Okay, no. No, but basically, it brought in a new market into the company and essentially increased. So I wanted to value Birkenstock for its IPO, but I also wanted to break out how much of the value came from each of these 4. I'm going to play a game here where I'm going to try to separate the 4. It's not always going to work out, but here's where I put in each of these intangibles. First, for the revenue growth, I used a revenue growth of 25%, which for an established footwear company is high, but it's high because they've got that management finding new partnerships. So I attributed that to great management. The first year, though, was the Barbie buzz. So after the 25%, it drops off. So I brought the Barbie buzz in and the management through the revenue growth. The margins for Birkenstock are about 23 to 24%. That's much higher than even name-wear footwear companies. That's a brand name playing out. So I put the brand name into the margin. because they can get celebrities to do advertising for them for free. Remember, this is their capital expenditure. They're going to be able to get much more revenue per dollar of capital than a typical footwear company. And that was where I put in the celebrity. And the fact that their production is centered in Germany makes it easier for them to control the supply chain. So essentially, I looked at all of the intangibles and found a place to put them in there. The value for equity that I got was about 8.4 billion euros. They actually went public around 8 billion euros. I don't know what they're trading at right now. But my objective was to show that the intangibles were all in there. In fact, when I was done with the valuation, I said, what if Birkenstock loses all of its intangibles? Its brand name, its celebrity clientele, its good management, and the Barbie buzz. Its value would have been about 2.6 billion. In fact, each of the chunks I've separated out. It worked here because I was able to at least separate out which input was driven by which intangible. But in many cases, they're all going to be mixed together. If you ask me to value each of the intangibles at Apple separately, I'm going to very quickly give up because I don't know where the operating system shows up. I don't know where the styling shows up. So essentially, all of those things are in the value. But if you do it right, all of your intangibles should be somewhere in there. Jessica, you were talking about intangibles just before the break. You sent an email about intangibles after listening to Scott, right? Do you remember what the email was? Yeah. So essentially, that becomes the challenge. Not that intangibles don't have values, finding an input that you put that intangible into. Because if it doesn't affect the numbers, it's just not going to show up in value. If it doesn't show up in value, why are we spending time talking about it, right? So essentially, anything of substance should show up somewhere in the numbers. And here I've tried to show it in the inputs. Valuing cyclical and commodity companies. It's the biggest challenge. We're a mature commodity company, but every time the commodity price moves, everything changes. It's like an oil company, right? So oil prices right now are at $74 a barrel. I say, what are your cash flows and existing assets? Show me your cash flows. Look pretty good. What's the value of growth? Again, $74 a barrel. Most of your reserves are viable. The value of growth is good. How risky are you? You're generating enough in cash flows. You don't feel very risky. And when will you be a mature company? Give me this pathway, maybe with declining growth in perpetuity. But when you're at $74 a barrel, I'll get one set of answers. Let's say I show up 2 months from now, and the price per barrel is dropped to $40 a barrel. Same company, every single question, I'm going to get a very different answer, right? At $40 a barrel, you're probably losing money. The value of your growth is negative. All your reserves have turned non-viable. You become very risky, not because you have more debt, but because that debt is now sustained by much less in earnings and much less in equity. And ask you, when will you be a mature company? There's a very real chance you won't make it if oil prices stay at 40. I show back 2 months later, it's $120 a barrel. Everything again changes. So the same company, every single question, the answer you get is going to depend on what the price of the commodity is. So the risk of stating the obvious with these companies, it's the macro assumption that drives the value of the company. An oil company, it's the oil price. Gold mining company, it's the gold price. And that'll tempt you to say, let me focus on forecasting oil prices to value an oil company or gold price to value gold company. And I strongly encourage you not to do that. And here's why. Let's assume that you believe that oil price will double over the next 5 years. You've talked to experts, you've done your research, that oil price will go from $74 to $150 a barrel over the next 5 years. If you value an oil company with those assumptions in place, you can save yourself the trouble because every oil company you look at will look cheap. Right? The $150 oil price will do it. But then I'm going to ask you, did you find ExxonMobil or Royal Dutch to be cheap because you like the company or because you think oil price would double? The answer matters, right? Because if it's because oil price will double, why am I looking at ExxonMobil or Royal Dutch? There's a far simpler way for me to make money, which is just go out and play oil futures or oil options, make my money directly on the commodity. I know it's going to be difficult to do, but your objective when you value commodity companies is to try to be as commodity price neutral as you can get. It's more difficult than it sounds. As you'll see when I try to value Royal Dutch, you want to try to keep your assumptions about the commodity price out of your valuation. So let me give you an example, and this is where I think using probabilistic tools can help you. I mean, I'm a great believer in Monte Carlo simulations when you feel a lot of uncertainty. For those of you who've never used Crystal Ball, I think Stern has a free version. Try it out. It takes any Excel spreadsheet and allows you to convert it into a Monte Carlo simulation. Where you take your base case assumptions. Don't do this for your DCF for this week, but if you want to, you can take your DCF and very quickly make it into Monte Carlo simulation where you take your core assumptions, revenue growth, margins, reinvestment, and make them into distributions. In a simulation, you basically run multiple outcomes. I think Crystal Ball default is 10,000 simulations, and it gives you a value under each one. So the company I'm going to use for this is Royal Dutch. Royal Dutch, old-time oil company. This is the valuation I did in March of 2016. At that time, the oil price was about $40 a barrel. I first had to restate the revenues for Royal Dutch at $40 a barrel. Why? Because oil prices had fallen during the course of the previous 12 months from $65 to $40. If I took the trailing 12-month numbers, they reflected a much higher oil price. So I actually had to restate the revenues with the oil price at $40. That lowered the revenues, lowered the income, but ultimately the value per share that I got was about $39 per share. Stock was trading at 42. But it's very dependent on what oil prices are. If oil prices go to $60 a barrel, that value per share will go to $55 per share. If they drop to $20 a barrel, the stock price probably dropped to $20, $15 per share. So here's what I did. I first looked at how Royal Dutch's revenues had moved as a function of oil prices over time. So that's 1988 through 2015. The red columns are the revenues per year. The line superimposed on it, the average oil price per year. Just take a look at the two series. Obviously, they move together. You don't believe me? I can give you an R squared. It's 96%. This is about as pure an oil price play as you can get. See this regression up there that I've run against the oil price? That will allow me to tell you whatever the oil price is, what the revenues will be as a function. Every $1 increase in the oil price increases my revenues by about $4 billion. So that's the number that I used. In fact, on the previous page, see that equation? That came from running this regression. It allows me to state what the revenues will be at any given oil price. And here's the final piece. Oil is publicly traded. So I was able to get a distribution by looking at oil prices historically. And here's how the crystal ball works. You pull a price out of the distribution, estimate the revenues at that price, operating income, value, repeat it over and over again. So first run, it might pull out a $52 oil price. Compute the revenues based on $52, operating income, value, do it again and again. At the end of the process, what you have is a distribution of value per share. See the median value, $37, that's very close to what I got in my base case. That shouldn't surprise you. My distributions are built around the same expected values. But I get a lot more information in a simulation. I can tell you worst case, best case, they're embedded in there, right? The 0 and the 100%. But the more useful are the 10th and the 90th percentile. I think of those as my reasonable ranges for the value per share. This morning I was valuing BYD. If you read my post on Tesla, I said I'm interested in BYD as a company. Right now it's trading at about $102 the ADR is, which is significantly above my value per share. I did a distribution. My base case value was about $80 per share. My 30th percentile was about $72, $70 per share. I put in a limit buy this morning at $70 per share. Zero chance of it happening in the near term, but who knows, right? Things can change in a hurry. So often one of the nice things about doing a simulation is you do a simulation, the stock might look undervalued or fairly valued now, but you can put a limit buy and put a good till canceled and just don't forget about it because something bad happens. You want to make sure you revisit it. but it allows me to kind of put that in. And the reason I want to put that in is if the stock drops to 70 and I then go and say, I'm going to think about buying, I won't feel like buying it then because I'm going to have second thoughts. Everybody's selling the stock. It's a great way of taking actions that you don't think you can pull off psychologically and making them automatic. And once it's in your portfolio, if you want to put a limit sell at the 70th percentile, it becomes a way again that you can take that out of your hands as well. Because if a stock goes up in your hands, you will feel the urge to hold on. It's done so well, I don't want to let go. Nice thing about simulations, it allows you to kind of automate that part of the process where you feel your psychological weaknesses might get in the way of your investing. So you're going to value your company, you come up with the value base. So all of this discussion has been about intrinsic valuation, cash flows, growth, and risk. You're competing in a marketplace where you're mostly traders, right? People driving the price, demand and supply. Start of the class, I talked about how the two can give you very different end games. That what you get as a value per share and what you get as a price be different. And there can be a gap. In fact, if you believe in efficient markets, that there is no gap. The two numbers should converge, but to the extent that you don't, there can be a gap. And for you to make money, that gap has to close. Something has to happen, the catalyst. So the rest of this class, we're going to put intrinsic value to the background and talk more about price. But to complete our discussion of intrinsic value, think about what you have to do differently when you do pricing. You almost have to have a mindset shift. You're no longer thinking about what's the right way to estimate cash flows. You're thinking about what do other investors do to come up with the price of the stock. For some of you, that might actually be a more comfortable place to be rather than trying to assess cash flows, growth, and risk. So when you think about value versus price, if you're a person who believes in efficient markets, there is no gap. What should you do? Buy index funds. Have any of you seen this new documentary that I read about in the Wall Street Journal yesterday? No. It's created by the guy who founded Dimension Funds. His name is Booth. I'll send you the link. It's actually a documentary about index funds and why, for most investors, it is the right choice. And essentially, you're taking the point of view that if there's a gap, it's completely random. We can't figure out which direction it is. If you're a value extremist, you know who I'm talking about? The people who show up in Omaha every year. Then you believe you own the high ground in value, that the price is always wrong, it'll move to you. At the other extreme, you have the pricing extremist. Says there's no such thing as value. It's all about demand and supply. I'm not going to push you into one of these three camps, but clearly there are these three camps of view about value versus price and how to look at the gap. So let's talk a little bit about when you value a company, what the dilemma is that you face. And this goes back to the start of the class today. When you value a company, you feel uncertainty about your estimated value. As you work through the DCF, you say, how do I know I'm right? How do I know I'm right? So revenue growth, okay? And the answer is nobody can check off and say, yes, you're right. You're uncertain about your inputs. Maybe you can say, look, and I can go out and collect more information. But in my experience, collecting more information doesn't make you feel more certain. It makes you feel more uncertain. I've been trying to value Mercado Libre for the last couple of days. It's a messy company. It's the Amazon of Latin America. But it's a company where you've got this very big fintech arm for the company, which makes it different from Amazon. I'm trying to collect information on what exactly they're doing, how they make money. And the more information I collect, the more confused I get about exactly what their competitive edge is. You can ask what if questions, right? And many of you have, what if my growth is high? But at the end of the process, you still have a value and a price. Or you can do a Monte Carlo simulation. As I said, you don't have to do it for this particular version, but if you want to bring crystal ball in, take your DCF and make it into a Monte Carlo simulation. But the bottom line is, even if you do all of this stuff, you will have an estimate of value and you will feel uncertain about that estimate. You'll also feel uncertain about when or whether the gap will close. So let's say there's a value and a price. Why should it close? There's no guarantee that it has to close. And even if it's going to close, how do you know when it's going to happen? So as a valuer, those are the two big dilemmas you face. As a pricer, we could talk about the dilemmas you face as well. But if you think about that gap specifically and say, what can cause it to change? Here are the perspectives you can bring in. The first is what I call the karmic view, which is I have the value, there's a price, there's nothing I can do about it. I'm just going to go back to the rest of my life and hope the price adjusts to value. For many of us, that's often the only choice. The second is if you can, and very few of us have this capacity, and you can you can be the catalyst to cause the price to move to value, it gives you a lot more power. At the start of the class, I talked about the advantage that a Carl Icahn or a Bill Ackman can have that you and I don't, which is they take a position in a stock and they can try to talk the price to the value. But even if you don't have that capacity, maybe you can look for things that can cause that change to happen. Now, one of the things I look for when I have a badly managed company, I'm saying, will there be change? I look at the age of the CEO, very morbid exercise. But there will be, when you have a change in management, some kind of reassessment of the company. You're looking for things that will make the market reassess value. Doesn't always work, but when you're screening for cheap stocks, maybe add a screen for something that will provide the catalyst, something that will make the price adjust to value. But you got the value, that's all you can control. There's a price that's out of your control. And for the most part, you have to just hope and pray that the price will move to value. I've got to update this, but I've been valuing Apple off and on now for a decade. And as I said up front, I'm biased. I love the company. Right? But I've over time learned to put some distance between me and the company in terms of valuing the company. So I first valued 2011, my value per share was 69, the stock price was 54, it's undervalued. Value again 2012, close to fairly valued, undervalued. You can look across time, it's gone undervalued, overvalued, undervalued, overvalued. It's a stock that, at least from my perspective, the market has a trouble nailing down because it keeps thinking Apple is a growth company and then getting disappointed that it's not a growth company. So it's almost you can go update by update. If an update works really well, the rest is saying it's back again. It's going to be double-digit growth. And smartphone update doesn't go well, then everything goes to the other extreme. But when you're an investor, you're trying to take advantage of that back and forth that the market makes. So with Apple, I've actually bought and sold the stock multiple times, just like I did Amazon over the last 15 years. For the last 4 or 5 years, it stayed because it looks like the market's finally figured out that this is not a high growth company. It's a mature growth company that as long as those updates keep working, will continue to be a cash machine. But often that's what you're looking for as an investor, is that steady state. You can just hold on beyond that steady state. But until you get there, you will have this adjustment process. You recognize that shot? My favorite movie. Anybody recognize the movie? The Wizard of Oz, right? Anybody know the story of the Wizard of Oz? As I tell you the story, don't jump down my throat saying that's so unrealistic. It starts with this girl called Dorothy who lives in Kansas. Is it a tornado that sucks her up? Some kind of weird storm picks her up, dumps her into this mythical land of Oz, where she lands on top of a witch. Wicked Witch of the West, East, one of those wicked witches, and she kills the witch. She's facing homicide charges. That's how the movie starts. First 5 minutes. If you have kids, don't skip the first 5 minutes. It's traumatic. Okay? So Dorothy wants to go back to Kansas, and she turns to this munchkin standing by the side of the path. And she says, how do I get back to Kansas? He says, I've never heard of Kansas. Go ask the Wizard of Oz. He knows the answer to everything. And she says, how do I get to the Wizard of Oz? And she says, follow the yellow brick road. For 3 hours, we followed Dorothy down the yellow brick road. She never walks. She hops, she skips, she jumps, And along the way, she acquires a motley crew. A lion that wants courage, a tin man, a scarecrow. They all want something. They're all told, go see the Wizard of Oz. He has the answer to everything. So 3 hours later, they make it into the chamber of the Wizard of Oz. They're there. Each of them states what they came for. And the wizard says, he's behind a curtain. He says, come back tomorrow. It's like a government office. He said, we've come 3 hours in this movie to get here. Now we'd like an answer. And then the curtain drops and they realize there is no Wizard of Oz. There's this guy pulling strings behind. But the whole point of the movie is that each of them found what they were looking for on the journey. See those red shoes that Dorothy has? It's turned out to be magical. She clicks the shoe, she's back in Kansas. The lion fought off some bad guys, got courage. You're saying, what's this got to do with valuation? Maybe it's got nothing to do with it, just one of my favorite movies. But in valuation, there seems to be this sense that there is a Wizard of Oz who knows the answer to every question. What tax rate should I use in valuation? You find the Wizard of Oz. Maybe that's Google search. The answer to every question you run into an intrinsic valuation lies in the process, right? Go back to basics. What am I trying to measure? And you almost always will be able to reason your way to an answer. To the question of what tax rate should I use in valuation? You saw the process of reasoning you need to make that judgment. And it's going to be different when you're talking about the cost of debt as opposed to the operating income. The answers to every question you will ever run into an intrinsic valuation lie in the process. Trust the process, go back to basics, because somewhere in there you will find the answer to almost every question you run into. And that's, I think, what we all need to remember when we think about, hey, because who knows what the questions will look like 3 years from now, 5 years from now, 7 years from now. But if you have the process in place, you can find the answer. So next session, we will start on lecture note packet 2. It'll be all pricing all the time, very different game. So come prepared for a different game. We talk about, you don't talk about cash flow growth and risk. We're going to talk about what do other people think my company is worth. It's a very different framework. And I will see you on Wednesday.
Oh, you watched the place.